If you've invested in battery stocks or you're thinking about investing in battery stocks, then this is a video that you're going to want to watch. So we've produced no fewer than a dozen research pieces on this topic, vetting all kinds of companies, and we've broken down the energy storage thesis into three broad areas. So the first would be lithium battery manufacturers. These would be the pick and shovel plays on energy storage. Then we have energy storage solutions providers such as STEM and Fluence, and then new battery technology developers such as the work Quantumscape's doing on solid-state lithium batteries. So before we get into this, I wanted to ask you to do me a favor and go ahead and click subscribe. On the lower right corner of this screen, there's a button that says subscribe. Click that, please, and subscribe to our channel. Many of you have asked how you can support us and keep these videos being produced, and that's how you can do it. So let's go ahead and talk about lithium-ion battery packs. They're quickly becoming a commodity play, and you can see how rapidly the cost of a battery pack is decreasing over time. What does this mean? Well, the larger producers will be able to use economies of scale and produce batteries profitably as margins shrink. And what's happening is that the cost component of batteries for an electric car is also decreasing over time, and electric vehicle companies are now starting to produce their own batteries, companies like Tesla and BYD. Now, we did an analysis on the largest lithium battery producers by 2028 based on forecasts that analysts have produced. And the largest would be this firm CATL in China. And then you see LG Chem, Tesla, BYD. Two firms on here were of interest. The first obviously being the largest, and they aren't publicly traded in Hong Kong. So when we look at Chinese firms, we'll only invest in H shares. We won't invest in VI structures. And if you don't know what that's referring to, I'll put a link in the description of this video that talks about the dangers of Chinese stocks. Now, we're going to go ahead and take a second look at BYD. The last time we looked at that firm, they're about a $100 billion manufacturer of electric vehicles. We last looked at them in 2017, so we're due for an update. In terms of CATL, we want to wait until they are traded as an H share. There were rumors this fall that they may begin trading in Hong Kong. And then there's Tesla, of course. Tesla and BYD, these aren't pure plays, and we're particularly looking for pure plays. Both BYD and Tesla also are fairly large firms. So when you look here at the optimal size of a firm we'd like to invest in, you can see that the large bucket between $10 billion and $100 billion, that's our sweet spot. So other firms that we've looked at, let's say mid-cap battery stocks, three names here we did a piece on: Varta, Enersys, and Simplo. In terms of Varta, they have a heavy dependency on Apple, and that actually has affected their revenues just as we warned, and they've had a decrease in demand. They build the batteries for those earbuds, and then there's been a decrease in demand for those. As for Enersys, we're actually holding that stock, and I'll talk a little bit more later about why that is. And then you have Simplo, a Taiwanese firm, and honestly, with a lot of these Asian firms, there's a localization problem where unless you read Mandarin, you're probably not going to be a successful investor because you're not going to be able to tell what's going on. So we would skip out on Simplo. Now, another firm that's often talked about is Microvast. And sure, they're selling a lot of batteries and equipment, but they're having a hard time making a profitable business out of it. And here we've taken the last 4 quarters and looked at the gross margins. So you could see total revenue and that cost of goods sold. What they refer here is cost of revenue. And there's just no profitability here. There's also a heavy dependency on China, where nearly all their operations are located. Now, I want to caveat that by saying when we have suspicions about China, that's because I've personally seen how bad things can be in China, and there's a lot of opaque firms over there that you don't really have visibility into what they're doing. Now, this vote of confidence for Microvast of a $200 million grant that they received in partnership with General Motors. That sure helps alleviate some of those concerns. However, we can't get past these very low gross margins. So Microvast isn't a firm that we would take any sort of a closer look at until they get that problem resolved. Another one that is often brought up, Enovix. They raised in 2020, the last time we looked at them, $45 million to complete their fully automated commercial production line. And in their recent shareholder letter, they talk about how they're continuing to push the boundaries of what's possible with their technology. We'd like to see more battery sales and less boundary pushing. So this $1.9 billion firm expects $11 million for 2022, and that number will magically rise to $176 million for 2023. So if they hit that 2022 goal of $11 million, that we consider that to be meaningful revenue because it's above $10 million, we'll come back around for a second look. Now, let's talk about energy storage solutions. These are probably some of the most talked about stocks that we're going to cover today. So Fluence Energy. Again, we see a problem where cost of goods sold is greater than revenues. That means they don't have a viable business. Now, of course, they'll argue, well, that changes as we scale. Cool. We'll take a look once you've managed to solve that problem. Siemens is a related party. They account for more than half of Fluence's revenues. That's a concentration risk. I believe they're also heavily concentrated in the United States. Nearly all their revenues come from selling hardware. We like to see recurring revenues, a component of that somewhere in there. And we say here, we'll take another look once they can show recurring revenues constitute a meaningful percentage of total revenues, because presumably at that time, they would then have a profitable business. STEM, 79% of their revenues come from reselling solar hardware purchased from other manufacturers. That's not the AI SaaS business that we had in mind. The low margins aren't promising either. And when we look at their recurring revenues, they've only grown 5% sequentially quarter on quarter. Now, whilst their revenues are certainly starting to soar, we need to see recurring become a bigger component, and we need to see better than the 9% gross margins that they have today. Again, that recurring element helps boost your margins in both of these cases, and we need to see more proof of that. Now, let's talk about new battery technologies. We put up a handful of companies here. These are all SPACs. You can see how well they've performed over time. We've simply taken the $10 a share price that all SPACs begin trading at, and then easily you can calculate the post-SPAC returns. 3 of these companies are above our $1 billion market cap threshold. We've put the cash down here, which should give you some indication of their ability to survive in the face of a bear market where raising money will become even more difficult. Now, just some updates on these firms. The most notable being Quantumscape. They're in bed with Volkswagen. Since their peak of $114 a share, the QS shares have fallen 94%, and they're not expecting revenue from sales of their solid-state batteries until 2024. Cool. We'll take a look then. Solid Power. This might be the best one of the lot. They beat their 2022 revenue estimates of $3 million. They're in bed with BMW and another major automaker. They have year-to-date revenues of $7.6 million over their estimates, but they're at half our market cap threshold of $1 billion. So we had said before, late last year, we're not entirely pessimistic with 2 solid automakers in their corner, but we won't fund the company's R&D. So we'll probably take another look at them next year. Then you have FREYR. They're licensing tech from a Boston startup that we've written about, I would think a decade ago when we first started looking at them, and they're building out production capabilities. We won't look at them until they have meaningful revenues. Same holds true for SES. They don't expect to see money rolling in until 2024. Now, also on our list is EOS. This is a name that's often brought up. They began shipping systems in 2018. They had $6.1 million in revenues for Q3 2022 with a cost of goods sold totaling $50 million. That's not a business. They're an $84 million market cap firm, so they're probably going to be in danger of being delisted soon when their share price falls below $1 a share. And they have about $38 million in cash. So they can either pursue debt funding or they can sell some of their extremely discounted shares. Not looking good for EOS. Then we have Energy Vault, and this is probably the most unique of the lot. So they've built this giant crane apparatus and it hoists these concrete blocks up and they drop them down and that creates energy. It's a form of energy storage that you might equate to like pumped hydro. So they've brought in a respectable $45 million so far this year, but when you read the fine print, almost all of that came from one of their investors as part of a $50 million licensing fee. That should be listed as related party revenue. It's not, which is a concern. And this party called Atlas Renewables, they're actually majority owned by a Chinese utility company. They're building out this solution in China. The whole thing just doesn't smell right, and we would be avoiding this firm. Now, when it comes to our own battery tech exposure, you can read our recent piece on Next Era Energy. It's quite relevant because it talks about the difference between a value stock and a growth stock. And this chart on the left here, that's how we saw EnerSys when we entered a position. You can see this nice steady growth over time and that they're profitable. And when you look at the bigger picture over 10 years, they've had a compound annual growth rate of revenues about 4%. That's not very much. That would hardly be considered a growth stock. And on the right-hand side here, you can see the quarterly revenues that slowly increase over time. So they pay a dividend. They're quite diversified in terms of what they do. There is a lithium component, but they also do lead-acid batteries. Slow growth. And they don't provide revenue forecasts, which is an indication of a value firm. So this really acts as a placeholder until we can find a more suitable company. Now, when you look at what EnerSys does, energy systems are 45% UPS, things like that, motive power, electric forklifts, and they have some specialty. 5G is said to be a benefit of the company as those installations increase, along with data centers. They have the largest market share in the Americas and European industrial battery market, but just a fraction of representation in Asia. Raw materials account for over half their cost of goods sold, with lead being the most significant. Again, that comes from their sale of lead-acid batteries. And they're expected to benefit from the Inflation Reduction Act. Here you can see where they've spelled that out in their most recent investor deck, which also dedicates a couple slides talking to how the company can be resilient in the face of a recession. So we don't see any need to move out of this position, nor do we see a need to increase our exposure. We're simply going to leave it there as a placeholder until we find a better way to play the energy storage theme. Now, the companies that we've talked about today, this slide here, this picture is taken from our tech stock catalog, which contains 430 tech stocks. This is just a small snapshot of all the fields that are available. And you can see here that we've simply gone down this list looking at these various companies. Certainly, we've missed some in today's presentation. You can feel free to post those in the comments section. We'll take a look at them. 3 rules. Please don't post over the counter. Make sure that they have meaningful revenues above $10 million and a market cap of, let's say, greater than $750 million. So to conclude, we haven't found a compelling battery or energy storage play. EnerSys is a placeholder, but resembles a value stock more than a growth stock, and we're just going to continue to watch this space closely over time, especially given the interest from investors. Now, if you're looking for another video to watch, before you do that, please go ahead and subscribe. Just click this blue button on the right, click subscribe, yes, and you're good to go. And then check out this video that we did on Next Era Energy, the biggest renewable energy company in the world. It's quite interesting. It talks about value versus growth. Thanks for taking the time to watch this today.